Hello, everyone. My name is Scooter. I'm excited to jump into our conversation today, to be honest. Obviously, learn a little bit more about yourself and like your path and journey and professional journey, and then really get into some nitty gritty things about fundraising. So I imagine this is what you would love to talk about on a Saturday, midday with the sun shining. And so real quick, I just want to know for people in the chat, put a 1 in the chat if you consider yourself an entrepreneur, if you are an entrepreneur, if you are positioning yourself to raise capital and funding. Great. Okay, this is good. We got some people in here. And then if there are any investors, you can put a 2 in the chat, I guess, as well. That'll be fun. But Brittany, I think first things first, again, just level setting and making sure that we all kind of know more about you. Tell me about your professional journey. And really, I want to go back to maybe the day after you graduated or after college, or where'd you go to school and like what that looked like? And did you know you'd be in venture capital?
Yeah, so everyone's path to venture is so different. And I was one who didn't actually know quite what venture capital was, even coming out of undergrad. So I'm originally from North Carolina. I went to UNC Chapel Hill for school, for college, and I studied business. So I kind of knew that there was this like early stage funding, but I never thought that I didn't know a career path into that. And I didn't know if that's what I wanted to do initially. So I went into investment banking like a bunch of people do. And I think that it was an interesting time because I was there during the financial crisis of 2008 and 9, and it was very challenging. But I think for me, it was also a time where I started seeing what was going on in the New York startup ecosystem. So as I was living in New York, working in banking, I saw 2 things happening. So one, I was in investment banking and I saw some of the IPOs from companies that started while I was in school. So like Facebook started when I was also in college. I had seen that journey and they're now going to IPO while I'm in investment banking, and I see the whole journey kind of from kind of an observer. And I was like, okay, that's interesting. And then I also know that I know people in my community, people that are Black people, women, that are also starting a lot of tech companies, but they're definitely not on this high growth path. And like, what is happening? What is the gap? Where are the resources for people that are not kind of the Mark Zuckerberg type? And why are they not getting this fast growth kind of scale to the point where they're IPOing within 5-10 years? We saw that whole journey. So that's when I left banking to see like, okay, I really want to figure out this kind of entrepreneur space. How can I help? Is it that I become a founder? Do I become a VC? Wanted to get in and get off kind of the investment banking path and into supporting entrepreneurs.
That's phenomenal. I have an older sister who also did investment banking. So were so this is a different level of entrepreneurship that you were seeing though. And so were you familiar with entrepreneurship, maybe even coming in like from a mom and pop level, or, were you like, okay, wow, this is a whole new ball field. I want to really go play in this space here.
Oh, interesting. So this is like my whole life. So I'll try to keep it fairly short. But my dad was actually, he's a technologist. He's been in software development. And he tried to start a company in Raleigh, North Carolina, tried to get funding, and really struggled with that. During the 2000 bubble, like when 99, 2000, everyone was starting a .com something. He also had ideas, and this, Black guy, North Carolina, could not kind of navigate or figure out that scene. So he ended up just going back to consulting and other work. And I know that there's other people like him that have ideas, are innovating on something, and can't quite get like the funding piece down. So I kind of experienced it growing up. But then I also was in kind of the Raleigh-Durham area, and I highlight Durham in particular because it's actually one of the Black Wall Street. I know Tulsa is one, but Durham, North Carolina was also referenced as kind of a Black Wall Street, where you saw a lot of Black businesses flourishing kind of in the 50s and 60s. They were having essentially access to capital, high growth businesses, all kind of in this one area that I was also kind of, as a, from a family perspective, had exposure to through, my dad telling stories about this area. So I knew that there's always this potential, but we're not getting kind of the support and the resources. So I think I always had an idea that I wanted to go in that route. And then I just saw that like it was essentially only really white guys that I knew that were either talking about starting something, like, oh, I have an idea for an app. I'm like, I know other people that are working on stuff, but I think they always knew that there was resources out there. And I think I kept trying to figure out what is the gap. So while I didn't have the path kind of laid out and I didn't see anyone in my circles doing this, I think those were sparks that were kind of early on that led me to pursuing this.
Well, I mean, I think we all have that story of like, a family member or someone like that, wants us, that, kind of sparks it a little bit, but then goes into it. Can you talk about the transition? So I think there is a world where people think if you're in venture capital, I guess you're more rich than not because you are on the side with the cash. But was it nerve-wracking leaving corporate Wall Street? Talk to me a little bit about that for us, please.
Yeah, I think getting into venture has not been easy from a financial perspective personally. And I think that's something, if you want to go into venture, there are not a lot of jobs that are just out there. So my path, I ended up working with a couple of smaller funds that did have some open roles, in particular with the thesis that I was going after, which that I had access to women and people of color that they were not funding. Like even when I started my career in VC, that was the kind of value add that I tried to communicate. And not everyone in 2015, when I was just kind of starting to get into venture, that was not something people were looking for. I literally had funds tell me, oh, well, that's not that interesting. Or coming out, so I went to Harvard for my MBA. So coming out of HBS, there's other people trying to go into venture capital. And I had a VC that said, oh, well, we're looking for more traditional networks. And I was like, what does that mean? Like, I have that in that I went to these schools, but I also am bringing you something you haven't seen. So I say all that to say, I didn't just like jump into a high paying venture capital role. I started working in the ecosystem at different early stage funds that were also getting off the ground. And then met Arlen Hamilton, who started Backstage. I met her while I was at another fund, and she was starting Backstage from scratch also. So while I was coming out of business school with kind of six-figure debt, it was not something where I had a ton of runway personally. She was starting Backstage with essentially no capital and really kind of pitching this thesis that there's value in funding underrepresented founders. So, she'll say it more than I think she's experienced it even more so, where, starting it from scratch with no resources was tough. But I think it's tough for a lot of people. Like I also just had a limited amount of time and runway coming out of an expensive school that like I needed to pay for. So I was also grinding in my own way, getting into VC.
Is grinding, which is like amazing, I think, to hear and think about, which is like phenomenal. So let's walk through this grind here, because I want to know about the entrepreneurship grind as well. What are some of the things that they're looking at you about in VC, and like how do you learn to evaluate a company per se? Can you talk about that for me? As you are, so like your background in evaluating companies, again, it was like a learning environment. Was Arlen like, hey, I'm okay with you messing up, like let's go mess up, like what's going on?
Yeah, so with Arlen, we really connected on the thesis of underrepresented founders. And so many of the companies that Backstage invested in early were ones that we learned that inadvertently I had actually brought them to Backstage because I had either positioned them for a pitch competition that Arlen was at and saw them and then invested. There were a lot of kind of overlaps. So we actually have a very similar thesis, which was why when she was building out the investment team in 2018, she reached out, and I was, pretty excited to join what she was working on because we're pretty aligned. But yeah, let's, talking about companies, I always really see some of the potential that underrepresented founders have, but a lot of VCs are still looking at really, really old school ways of thinking how to predict value or how to predict success. So, okay, making sure they came through my network of other, high kind of elite schools or elite jobs. Like think of the big tech companies. Did they come from Google, Facebook, whatever? Like a lot of VCs are still kind of checking those boxes. So I always made it a point to think of, what are other ways to really get to know someone and their company to predict success that are not those factors. So I'd always had kind of a way of kind of at least being open to different life experiences and understanding what have they done to get to the point that they're at versus just seeing where they're at and expecting them to have X dollars of revenue or already have an app in market. All those things that I think a lot of VCs are still doing to predict success. I'm looking at, what have they indicated based on their experience that predicts success, and really getting to know that. And I've brought that to Backstage, and it aligns with what Arlen has already been doing at Backstage. So I think it was kind of, that's how we, work together in building out all the investments that we've done. And I will say with Backstage in particular, we invest quite early. So we spend a lot of time getting to know founders at the pre-seed and seed stage level, and understanding the opportunity that they're tackling. And then with that opportunity, why is it them? Why is it that founder and that founding team that can really be successful with what they're building? And if we can understand that at the core, and we're still excited and we see what the founder sees, we're willing to kind of get in and help them in that journey. Okay, so I see a question, kind of what led to the GP role? Yeah, so this is something, if anyone is interested in becoming a VC, I actually think my path, I really would have wanted to be a successful entrepreneur and then a VC. But I really struggled on the entrepreneurship side with raising capital, which is actually why I decided 100% I need to be on the venture side. So I glossed over that a little bit in my intro, but while I was taking time to pursue my MBA, I did start a company with a tech co-founder, because I also saw like, okay, well, if there's more people like me, building companies, taking that risk, it will actually just improve the industry overall. If more people saw that people would do, there's lots of Black women building companies, and I could be one of them. So I did go that route, and I met with a VC, multiple of them. I actually met with probably about 15 to 20. One of them actually said I was the first Black woman. I asked him, I was like, after about the 10th VC that was, an older white man in Boston, I was like, so something feels a little off about the fact that I don't know or haven't met any people of color or women investors. And he flipped it and he was like, actually, I don't think I've ever met a Black woman that's pitched me. And then we both kind of sat there. I was like, okay, I think this is the bigger problem, right? Like, what I was working on was interesting, but I think I would have a better skill set in the venture side. So that's kind of how I fully switched over, if that is helpful to anyone. But I think it is helpful if you've already been successful with your company, and then can have ideally some type of exit, so money, and then going into VC. But with Backstage, it was really that. Oh, go ahead.
The technology god's not with me. I apologize. Continue. I feel like you're getting into a question right now.
Yeah, no, I tried to answer. I was seeing if anyone had specific questions. Just on specifically getting into venture, I kind of just dialed into another point, particularly for entrepreneurs. I would have rather gone the entrepreneurship path, gotten some money and an exit and some success behind me, and then gotten into VC. That was actually the plan. but I was less successful at the entrepreneurship side, and then pivoted into venture because I saw that I could be better at kind of seeing opportunity and helping other people get there through finance, which is basically just funding companies. The entrepreneurs are doing the hard work. So that's that story. But yeah, happy to pick up where you would like, and then we can come back to some of the questions.
Yeah, no, 100%. And since we lost time, we'll kind of zoom kind of through your professional journey, if that doesn't, if you're okay with that, and kind of move into some of those things. So let's talk about, the mindset of the entrepreneur when they should go in to to pitch a VC and they have that moment. Because I think we heard today that there was a point around, a 90 in school and college gets you an A, right? But sometimes a 90 doesn't cut it when it comes to venture capital, right? Things need to be in tip-top shape, right? And we also know the product and revenue and those types of things. But what would you say to someone who is maybe discouraged just because maybe revenue growth isn't, it's in their early days, right? They're still looking to find product market fit. They're still testing out a couple revenue models. Should you be shy and not want to talk to investors if your numbers are not where you believe they should be or stellar in the early days?
No, you should be building relationships with investors if you believe that you want to raise capital eventually. So the best time to raise capital is when you actually don't need money. So I know kind of founders, and I've been there, you kind of always need money, but you don't want to be waiting to the very end and your company's about to shut down and you're just now starting conversations with people that could invest. So kind of with that said, you want to be thinking, even if it's early, I talk to founders who are pretty early stage, but they want to start building a relationship and kind of see how I think about what they're working on. And it's a good way to test investors too. So I would encourage early conversations, but make sure you frame them that, I'm looking to get a bit of feedback. I'm thinking about raising in the next, whatever that milestone is, if it's next 6 months, next 3 months, whatever your time frame is, kind of loosely lay it out for the investor and just say, I would love to hear I know you invest in this space, or these types of founders would want to understand how you see the space, or if I could explain my company to you, is that something that's interesting? Getting on their radar early is always good. I've seen it. I've rarely seen it the other way, where at the very end you're kind of like, I need to find investors and then try to make that work. So you don't have to have everything figured out. And the best investors will kind of work with you. If you're working on something interesting and pique their interest, they kind of will say, okay, well, pick back up the conversation when you have this. And then you might have okay, I got my first customer, and then they see what you can do over time. Because we're also trying to understand how you operate, and we want to kind of partner with someone that we can see where you're going and have had a chance to build that relationship.
Yeah, no, that makes sense. So what are some of the mistakes that you see they do when they are reaching out to you? Maybe just with how they're reaching out and mistakes that you see in their deck. What are some things that if the entrepreneur right now is listening can go back and go, oh, let me actually switch that up?
Yeah, okay, please spell our names correctly. Sorry, that's something that I have to say because Arlen has been called everything. We're like, how? Oh my gosh. So just address the person. We're people. So, try to get that kind of thing correct. And then I would say one mistake we see is pushing a little too hard on, I guess you're fundraising and you need to close within the next couple weeks or tomorrow or something. And you can kind of sense that, and it becomes a little bit, it puts us on a bit of I wouldn't say defensive, but essentially we're less open to wanting to get to know your whole journey and where the company is going. If we know you're okay, I trying to close this round in the next 2 weeks, and we're just now talking. That's tough. I'd say the timing can be difficult. And then not knowing anything about us or Backstage is also something that I would say is a red flag. So usually providing why you're reaching out is helpful. You're interested because you've seen maybe one of our portfolio companies and you have maybe something in that's similar, or you can use that to say how you understand how Backstage looks at things. We might also be interested in what you're working on or something. I think just tying in how you're relevant to us specifically. We know you're excited about your business, but why would you want to work with us versus, there's other funds. I'd say those two things mainly, just making sure you address us correctly and in the right amount of time so that we have some time and we're not put on some really hard timeline, and then we can build a relationship.
Got it. So building a relationship, obviously super key. Now, I think, there's questions around that say, what are the benefits to having an investor versus bootstrapping? So let's say we actually like, how do I know I actually need to like get in this relationship, right? Arlen seems like a nice person. You seem like a nice person. But when we're actually committed together, do things change? Like what exactly should the entrepreneur be ready for when you are exchanging, giving them $1, $100,000, $1,000,000?
Yeah, so you want to bring people on your cap table, and that your cap table is just your essentially the record of who owns shares in your company. So you want to bring on people who are owning your company, people that you actually really want to work with. So I say that, entrepreneurs should also be kind of vetting the investors too. But I will say with bootstrapping, there are benefits to bootstrapping, and you'll hear this from Arlen and how I think as well. Like if you can bootstrap for as long as you can, there's so many advantages in that. One, I think you retain just more ownership. If you can get to a higher point in your company in terms of traction before you start fundraising, you actually keep more ownership than if you raise capital day one and you're already giving up ownership as soon as you're starting.
Yeah.
And you can command more. It's an easier conversation if you say like, okay, we already have a few million in revenue, invest or not, versus saying like, I need this. And if you focus on getting the capital from your customers, like revenue, it puts you in such a better position with investors. So I will just say bootstrapping is like, we look highly on that, where founders can get kind of farther along without having to give up ownership. But I will say there's a point where you have to just figure out what type of business you want to run. And if you want to run a really high growth and scalable company that you think can deliver venture returns, which really means you're thinking about like 100 million, 500 million, $1 billion company. If that's really your ambition, you will need to raise venture capital at some point, most likely. I think there's some exceptions where there have been people that have bootstrapped to this, unicorn status without capital.
MailChimp or whatever. Yeah, those types of companies.
Yeah, we can definitely point to some. But I'd say for the most part, it does make sense to raise, if that's the goal, you want to grow kind of big and at a pretty fast clip, then VC can be incredibly helpful. We spend a lot of time with our founders just navigating future fundraising, like raising more capital. If you're going down that path, you're likely going to raise more than once. So that's huge. I'd say we also help with hiring, because it's not just the capital. Once you have capital, most likely you need to build the team. So especially early stage, we try to surround you with other resources than obviously the check. The check is super helpful, but then all the other stuff. So I think there's benefits, but also benefits to kind of moving at your pace. If you want to be bootstrapped, do that as you figure out the business. And when you figure it out to a point where you just need fuel on the fire, then bring in the VCs, and then you'll see your company kind of, you'll have a much easier journey on the capital, the fundraising side, if you do it that way, I think.
Yeah, no, these are great points. And I think the schools of thought, right? So, hey, I have this business. It's obviously making revenue from customers. I'm keeping my operating costs down. I'm bootstrapping. I'm winning pitch competitions. To your point, there may be some family friend rounds to get some quick angel rounds. But when I'm ready to put the gas on the fire, then I'm going to venture capital companies. So on that point, real quick, just again on reaching out, it's, how do I know that there's a right fit? So should I also be interviewing, when I'm talking to you, how do I find, more about you, do that due diligence? Should I be talking to other entrepreneurs who've taken funding? What should I be asking them? Can you talk through some of these like conversations I should be having when I actually get a foot in the door and say, oh, hey, I got connected to Brittany Davis. Like, what happens next?
Yeah, I'd say there's 3 avenues that you can pursue for this information. So one is public information. So I'd say go to Twitter. I think a lot of VCs hang out on Twitter. I'm working on that. I think Arlen does an amazing job at, communicating just her thoughts, what she's up to. A lot of VCs do that. So kind of understand who the venture capitalists are, especially if they have personal accounts on social media where they're sharing all of this. I'd say just find out as much as you can about kind of who they are before any other steps. And then secondly, I think it is with other companies. if you are, if you happen to know or can reach out to portfolio companies, different companies that are in our portfolio, I'd say the second thing is they're also on social media. I think of one of our, I'll put him on blast here. He's such a good kind of connector within our ecosystem. His name is Harold Hughes, and his company is called Bandwagon. He's amazing, and he connects a lot of founders to Backstage, and he's a Backstage portfolio company. So if you wanted to know anything kind of about what it's like, yeah, I see people in the comments, like, he's amazing. So there are, every portfolio I'm sure has founders like that. So just trying to understand, and you can look up maybe on Crunchbase is like a data source for VCs showing VC funding, what companies got what funding. If you can start just doing some research and seeing what, or just going directly to the venture capital website, the VC's websites, seeing the portfolio companies, and then seeing, can you actually get any insight from any of the founders? And in this same lane is communities of founders. So there's lots of communities that I'm seeing kind of form. Like there's like Black Women, I think Black Women Talk Tech. There's another one that's like Black Women in Tech Facebook group. There are other communities where there are people in those communities that have gotten funding from a variety of VCs. So just kind of being able to tap them and say, oh, have you ever had a conversation with so-and-so? How are they? So rely on your founder communities. They're the most valuable communities that you have throughout your journey, and that I've had that, and that's been valuable to this day. I still communicate with people that are, when I was a founder, still in touch with people that I met through my founder journey that are still founders or now have started their own funds. Stay in touch with the founders that are going through the journey while you are also going through that time. When you're all building together, I think there's something special. So other founders, and I think the third one would be in the conversation. So I will spend a moment of time on this because I think a lot of underrepresented founders need to hear this, and I needed to hear it. So I'm just going to say it even for my past self. There's this weird power dynamic when you're meeting with investors, right? Like they have capital and you're asking for capital. So somehow the power is going to the VCs, but that's not actually what's happening. And I want to tell all the entrepreneurs that it's actually you that have the power. Like, you are creating value for us. Like, I don't make money unless I meet with an entrepreneur that's building something amazing. So if you can really internalize that, you can ask whatever questions you want. You're actually turning the tables. And I've been in conversations where the founder is empowered that way and thinking about it where, obviously they need resources. We all get that. But they're approaching the conversation knowing how valuable what they're building really is. And they're essentially letting us in. And I think even if you have that mentality, it doesn't come off as, and don't come off as kind of cocky about it, but it's more just knowing what you bring to the table, and that how the industry works is that we only make money if you do. So I think just internalizing that somehow then allows you to ask whatever questions you want so that you're getting what you want out of the relationship. Like, you want someone who you would like to win when you win. So then you can ask whatever you want. And I think a lot of founders ask kind of how we work with our companies. What do you provide when, things are going bad? Ask all the questions that you would want to know that, you're letting someone in on the shares of your company. So I think those are kind of, I think those are some of the ways that founders can kind of start digging into the VC side, but just know that you bring the value. That's hopefully a takeaway.
Like, you're the one that's actually leading the company that's going to get the $1 billion, valuation.
Yeah.
Like, and you also know more about the space than, maybe XYZ investor, right? Which I think is also key. Okay. So just, again, trying to set this like persona up, right? I've got a company. It's a great business. It's, I've worked really diligently. I've built a little bit of a team, started to make some revenue, exploring past there. That's kept me in business 6-7 months. I hit the 8-month mark. I'm starting to make $10,000 a month in revenue. Now I have a $100,000 business. Okay. I see a path to like double that or triple that. And I start to your point, do like online research about Backstage. I'm interviewing Harold, I'm talking, I'm like, oh, is Brittany a good person? Okay. Now I come to you and I'm like, how do I start to think about the math, right? And I think this is an important piece because math is a big piece of finance, right? I mean, it is what it is. And so can we just talk about like valuation? Well, first off, just how much do I need, right? How do I cleanly say, why do I need $1.5 million, right? And how do I lay that out clearly to someone? Or do I need 2? Or do I need 10? How should a founder start thinking about that? And is that something that takes them out if they say, actually, I don't know how much I need. I just know I need the capital. Is that just a no-no? Talk to me about that.
Yeah, so I think it depends on where you are in the conversation with investors, where you can ask that. So if you are building the relationship, as I mentioned, and you're just getting some feedback and thinking, and working with the VC in that maybe that first conversation, explaining what you're doing and thinking, you know what, I might need some capital. It's really 2 things. So one is you need to know, like, what is that milestone that you're trying to hit? So I think you mentioned the revenue. Looking at your business, if you're trying to get to, let's just say like $1 million in revenue, so you're at 100K, you see a path to getting to $1 million. How long will it take you to get there? And what do you need to do to add to your team, whether it's marketing, sales, other staff development for product development, that sort of thing. Just knowing the resources that it'll take to get to that milestone is how you usually can back into how much you need. So it's a function of the milestone as well as time. So if you think, okay, I want to get to that $1 million of revenue, and it's probably going to take me about 18 months or 2 years. So what is your burn rate? How much does it cost to exist, adding those resources and sustaining yourself over those 2 years? And then that will give you around the amount that you're looking for. The third piece is always the piece where, like, how it actually goes down is then kind of what is the market? Where's the market at where you are looking to raise? So right now, like, pre-seed rounds have gotten just bigger. So I think there's now more, like, let's just say you only need really 100K. I think it is actually really challenging for founders to communicate like less in some ways, because then it seems like you're not actually going to grow as much. So I would say that's something that you should kind of workshop with an investor once you have interest, is say, like, okay, I could get to X amount of revenue if I only took 100K, or I would get to maybe another figure of revenue that's maybe double that if I took a little bit more. I think VCs would always push you to actually kind of see if you can get that next level of funding, because we're trying to invest in something that we see will actually take off growth wise. Yeah, so the takeaway there is that you kind of figure out how much you need based on how long you want to survive and get to a certain point. But I think there is some level of kind of talking it through with some trusted investors. Like we've had that conversation with investments, portfolio companies when they were quite early. It's just like, okay, maybe you should hit that $1 million because we can see how you might need that. And it might be just a round number that more investors are able to get behind. Like there's all those weird dynamics with other investors seeing like, okay, $1 million seems like a good number.
Is there too much, Brittany? Do you find that entrepreneurs are asking, especially underrepresented founders, are we asking for too little, right? Are they coming to you going, hey, I just want to raise 50K or 25K? And you're like, I can't even write a check for that low,
That's such a tough, you're right. Cause I think that is a problem with just venture. And I think then we would direct you to something else. If you really only need that amount, maybe it is something where it is like pitch competitions, or you can find maybe 1 or 2 angels, maybe potentially crowdfunding. I think that's tough because we do need you to be on a path where we can justify like aggressive growth. So if you only need that much, that little, is that going to get you to the growth? It usually costs more. Like we just, yeah.
So then I'm turning to maybe like community banks or crowdfunding or something like, to your point, winning pitch competitions rather than maybe like going venture.
Yeah, or grants. There's definitely some alternatives if you really are just looking to plug that type of hole. If you are looking for serious kind of investments in the company by bringing on different staff, continuing with tech development, it usually is going to take a bit, especially if you're the timeline for different raises, just to level set for everybody. You usually are trying to raise for about 18 months, because if you're on a venture path, most likely you're raising at least one or two other times. So you would think, I need to prove out something, get to that milestone in the next about year and a half.
So,
and that's what I'm raising towards to get to, if that makes sense.
So how do I get that number? How do I get that 18-month number? Can you break the math down again? Like, let's really dig in here. So what am I looking at? Like, how much I'm spending on? What is 18 months? What does that mean?
Yeah, it's what it takes to sustain yourself. Like, it will be, it's called burn rate, but the amount of expenses, like, what are you actually spending to live, to pay your employees, everything that the company is, all of the company expenses over that time frame, so that you can still exist. So you would need to see how much you're spending, and
including your own salary as an entrepreneur.
Yes,
right? Because if I
100%.
raise money, I don't become a millionaire by taking $1 million from you.
Oh no, oh no, and pay yourself. Oh my gosh, just side note, that's something where I think a lot of underrepresented founders are not doing, and doing, or at a lesser degree. I mean, you should be able to still have a quality of life where you are still adding value to your company, and not so stressed and not so kind of burdened by not taking any salary if you raise money. So if you're raising money, just add yourself in the line items of things that you are paying for. And an investor understands that. Like, we're not looking to fund you getting $1 million salary, but we are looking to have you have a comfortable lifestyle so that you can focus on your business. That's just a quick little advice.
So I'm eating ramen noodles. I'm making pennies stretch. I start to find some revenue, starts to kind of maybe double, triple. There are some new things I want to go do. I start to go to a venture capitalist. And I also say to myself, okay, I can maybe stop stretching pennies a little bit, pay myself $70,000 a year, 50,000, you know, what is the...
Yeah, I think it depends. It depends on where you are, like geographically. And it depends on the skill set that you had, and maybe like a prior salary. So I think there's definitely some factors. We don't want to see it, like, if it feels like you're getting, I don't know, I'm trying to think of a good cutoff, but it does vary, because I think in the Bay Area, for example, it's totally different than, somewhere in the Midwest, and we fund companies all over. So I wouldn't judge, the Bay Area person getting 100K, but I might say, maybe somewhere in a smaller.
I'm living in Memphis. Do I need 250 salary?
Yeah, and so we take all those things into account, but just know that you can make the case for having a comfortable enough salary so that you are bringing your best self to the job. Like, we don't want you to feel like you have to, your family suffering, you take on a side hustle. Like, we don't want any of that. And no investor, I think all investors want you to at least pay yourself, and you should feel comfortable doing that.
I think that is one of the best gems that has been said on the conference today. And I think it's overlooked, right? That we should be able to do that as an entrepreneur. Okay, let's keep going down the road. Let's go deeper in. Let's say I've followed Harold on Twitter. I asked him about Backstage. He was kind enough to introduce me to you. You think the business is great. I start to get in. I've already done some math. I'm spending, this amount, 18 months, a year and a half. Probably need to raise 1.5 million, 1 million. If you start adding in salary for myself and a couple of my other team members, what happens then? Talk to me about like valuation. So because you're giving me $1 million, $1.5 million, and you're saying my company's worth something, can I say, like, actually you're valuing it too low? What happens when I value it too high? Is there, I'm hearing about companies being valued at $4 billion. Is that good? Talk to me about where I want to find the valuation of my company when talking to a VC.
Yeah, I think in the early stage, it's more art than science. So a lot of it's not necessarily based on things that you actually have accomplished. It's more, I'd say actually a lot of it is how much you're actually raising. So something that we use to back into a comfortable amount is that you really should not be giving up essentially more than 20% of your company in any round. So let's just say you kind of, and this is totally just kind of back of the napkin speaking, but if you're looking to raise that 1 million, then your valuation, we would think that you probably have about anywhere from maybe a $5 to $6 million valued company. Is just, that's how kind of the ranges start to shape out. So to take a step back though, if you are raising early stage venture, the majority of deals are actually done on either convertible notes or safe documents, which just kind of allow you to raise the amount that you need to raise without actually putting a hard number on your valuation, because we really don't know. And I think that's something where I want people not to get hung up on the valuation. Think about how much you actually need and what the ranges are in your market. Because that's another thing where I feel like it can be challenging. We invest across the US and a little bit globally as well. So why I say that is that, you know, in the Bay Area, we see a totally different kind of valuation. At least we used to. I think COVID actually might be shifting some things, so might have to reevaluate this comment in a little while. But we used to see more things be just more expensive there. So pre-seed rounds could range, you know, up to 8 million in a valuation cap. And a valuation cap is just what we put in the documents. You'll see it as like, if a safe note or a convertible note has a cap, basically that's where we're effectively pricing your round without putting a hard number on it, so that as you raise in the future, we essentially bought in at that price. If that, yeah, I could do a whole talk on convertible notes and safes, because that's how we invest. Probably 90% of our investments have been on those documents, because that's what you're using in about 90% of pre-seed and seed deals are going to be a convertible note or safe.
Got it.
Don't get hung up. Yeah.
And just to make sure I'm clear, those are different instruments than like the actual priced round. So safe convertible note, let's just go down that path. It's more debt, right? Essentially, is that accurate to say that it's along that line?
So convertible note, unfortunately, I think it was structured where there really wasn't an instrument that really reflected a future equity amount, and that's why safes were invented. I think YC, you can look at the history of where the safe came from, but a safe is kind of a cleaner convertible note. So the convertible note just meant that we're buying something that has a future value that we convert in the future when you do have a price. Right now, if you're pre-seed, you don't have a price. We're giving you the money that you need to raise. But in the documents, you'll see that when you hear like, okay, I'm raising at a 5 million cap, that's really kind of the implied valuation, so that the investor kind of knows that they bought in at that level. Because as you go to raise more, let's just say you're wildly successful and you raise, I don't know, at a $20 million valuation in the next year. We bought in in the convertible note where the cap was listed when you first were raising. So yeah, a convertible note just means that it's something that you're basically buying into that converts into the equity at a later date, because we don't know the value of your company for real until you actually raise a priced equity round. And a safe is just a very simple way of saying that. It actually stands for, I think, statement or something, agreement for future equity, a statement of, yeah. Okay. So that's kind of what you're talking with an investor, and you agree on an amount that you're raising at a certain capped level, so that they know I'm buying roughly this amount of valuation, but it's not set in stone until you actually raise the
so then when I do my 18 months and then I say, okay, well, we think the company now is valued at $25 million, right? Your portion is based on the $5 million level, not the $25 million level.
Yeah, so that's the benefit of coming in early, is that we're setting kind of a range of a cap, so it's capped at that, so that we get that amount of ownership, but you didn't have to come up with a valuation at that date, at that early date when we really don't know how much your company is. Thank you. Someone said simple agreement for future equity. But yeah, that's basically what it is. You're agreeing to buy the company, into the company now, even though you haven't agreed on how much the company's valued until they reach a valuation at some future date. So it sounds complex, but it actually simplifies things a lot for early stage founders.
Let's talk about that complexity. You obviously are nice and you are breaking it down for us, and you probably walk a lot of entrepreneurs through this on the daily that you interact with. If I'm an entrepreneur right now sitting in at home watching this conference and I'm like, Brittany just said a couple terms I don't really know. She's converting math really fast. It's taken me a lot to really just kind of think in that space. What are some steps that I can do to get stronger, more confident there? But also, like, you know, the reality of what should I be looking for in this contract, right? What should I be looking for in this term sheet? What's something that's a total no-no if a VC, because you don't want to run into like predatory, I guess, VCs, right? Or people who take advantage of you, which I'm sure can happen very quickly. I think we obviously know our counterparts in like the music industry, right? They signed a bunch of agreements. They got some gold chains. They got $100,000 up front and it felt good. And I don't think, you know, entrepreneurs want to run into that where they're like, oh, you know, I have the press article, I have $500,000 now, I have $1 million now, but at the end of the day, like, I don't actually own my company anymore, or actually call it a bad deal. What should we be looking for so that we can make sure we have a win-win? Obviously is what you probably obviously want, but what specifically should you say, like, that doesn't look good, or like, you shouldn't have this much access? Can you talk to us about this a little bit?
Yeah, so in the early stage, most of it is around the kind of how much you're raising and how much the valuation cap is, because you're on one of these either convertible notes or safe documents. Still, it should work out where you're not giving up, your total round size will not give up more than 20% of your company. So that's something where I think I've seen some bad deals where like the founder's raising $1 million on like a 3 million cap, and that's, you know, you're diluting yourself so much, even though the cap is not real at the time that you're raising, like that's not your real valuation. That's how much the investor's buying in at when you do reach that valuation. So I'd actually say at the early stage, most of it is just making sure that the amount that you raise matches kind of where you are with the valuation cap that you're setting in the documents. So we see, like, for example, I'm thinking of a company just recently, they ended up raising a bit less because they were fairly early. So they were only, you know, can really justify maybe a 2 or 3 million cap. So then they only raised, I think, maybe 500K, which is fine. But if they realized they were getting a lot of interest and now could continue to raise on that note, it would actually start hurting them too much, where they were getting diluted if they went higher than, I think 500 is kind of where they should have capped it, if their valuation, their implied valuation on the note or the safe was only 2 to 3 million. So at the early stage, a lot of it's that dynamic. You're not really at the early stage, you're not typically giving up like board seats or control. That usually comes when you are setting a priced equity round.
Should I ever give those up? Let's meet someone tomorrow and they're like, hey, here's 50K, but I want to be on your board. Is that like, ooh, see? Okay.
Yeah. So I think that's tough. Like, I think they'd have to bring a lot more than that 50K check, which might seem like a lot at the beginning. But board seats definitely need to be strategic because they have voting rights and can potentially vote you out of the company if you set up your board where everyone is against you. So you need to kind of make sure that the board are all people that have the company's best interests at heart. It wouldn't be just somebody that just came up. Like, actually, Backstage is not on. We're only on the board of. Let's see, I don't know the count offhand, but let's just say it's less than half of the companies. So we invest, but we're not typically on the board until they're forming an official board, probably at the Series A level. And then you're looking to bring on an odd number of people. You vet these people. So it's like you want to have 3 to 5 seats and, you know, industry expert, maybe, yeah, you have to think about that. That's, again, a whole other topic. But at the early stage, just make sure you're kind of working with people that you want to potentially bring on later to your board, and that would have voting rights, that would have control. But at the beginning, make sure that at least you're not diluting yourself to a point where it doesn't make sense to even, or you can't even raise anymore. So yeah, I think those are priorities.
And let's talk about that, right? We've all seen the social network. Eduardo at the end is really upset because his shares diluted so much. Can you talk about that, where founders at the end of it, so we've maybe heard these reports, wow, Scooter did a great job. He raised $10 million. He raised $2 million. He raised money. The company went on to sell, and he was actually left with nothing. There was actually, he didn't actually become a millionaire after selling his company for $10 million. Does that happen? Is that possible? And why does that happen? And how do you not make that happen?
Yeah, it can happen. And I think the main reason that I've seen this happen is where a founder does dilute themselves, so sells too much too early. So like I said, in that first round, that one example, I know I saw a company raising $1 million and they only had like a 3 million cap valuation. So you're already giving up so much of your company. So I'd say, one, just be careful of giving up any more than 20% in one round. Like, that's just the rule of thumb. It can be less than that, but definitely don't go over that unless there's something incredible. Like, there's exceptions always, unless there's something incredibly strategic that there has to be something where you would give up that much. So I'd say one is founders typically do that early, and it's hard to recover if you give up that much so early. I'd say the second thing is raising at a down round. And I'm like, that's a whole other thing. But a lot of companies, like in recession times, or just when things are not going well, but you need money to continue because you can see the other side, but like you're going through some stuff. Some of the just the down rounds or venture debt can be tough if you don't recover at the level that you need to make your shares worth it, I guess. Because you can end up diluting yourself. Mm-hmm.
Let's talk in plain terms here. What does that mean? You're saying if the company doesn't do what it's supposed to. So when I'm saying I'm raising this cash, my company is going to be worth $5 million. Let's say something happens, sales aren't where they need to be, the product doesn't deliver. So that's why. So just, can you take us back into, like, while we are talking about all of this, why it's so important, I guess, on the day to day, the week to week, the month to month, to be actually executing. Right? Because after 18 months, we're going to look back and go, what happened? Right? Yeah. Did the product sell? Did you actually release version 2, version 3? Were you kicking things down the road saying it's coming soon? And now you're saying my company actually isn't worth $5 million, but I already raised enough money. So then when I try to raise more money, they're not going to believe it's $5 million. Like, talk to me there. What's happening?
That's the problem. So if you're raising at the valuation, like, okay, 5 million, and you're looking to get to a place where the next round, you would need to increase the valuation for the next round. But it does happen where, let's just say we went through COVID or where there's some recession and you do need capital because you can still see where you want to go. Unfortunately, you might have to raise at a valuation that's either the same or lower than what you had originally raised at. So that's when essentially a down round will dilute yourself based on the proportion of how much you're raising. You might have to actually give up a little bit more percentage of your company. Since we're not working with numbers here, but that essentially the dilution comes from you, the shareholders like yourself, potential employees, people who own and operate the company is where the dilution is coming from. The new investor and prior investors, the new investor that's giving you the fresh money is buying in at a particular valuation where your company is now, and it might be in a more challenged place than it was before. So if that happens, if all the things are not going well, unfortunately, to get that extra capital, it might just, you might have to pay essentially a little bit more for it, and it comes out of your pocket because you had the shares before, and that's kind of how dilution works. So I think you do need to be very careful about overvaluing your company. That's actually a really good point that you brought up, because some people spend too much time thinking about valuation, I think, and then think, oh, I need to have this high valuation. Actually, that can sometimes be tricky, because then you have to keep, it's a higher bar that you're constantly trying to prove out. So if you start out at like a 3 million valuation and then you're trying to raise next round at a 6, that's doable. But if you already start at 6 and like then and it doesn't go how you think it should go, then you're trying to raise again at maybe it's still at the same or potentially like a 5, then it's expensive for you. You're the one that gets diluted because you sold before at a higher valuation.
Okay, and I want to point back to the chat. We're going into some topics here. Let me know if we're on base. You could put a 1 in the chat if you're like, keep going. Put a 2. We'll stop and go to audience questions right now. We are going to get to audience questions, but I want to talk one more piece here, Brittany, and I know we're coming up on time as well. So I've taken this cash, to your point. I have this valuation, and then we start to think about the outcome, right? I want to go sell the company, right? If I say my company is valued at $3 million, right? $5 million, right? Or, we look at some of the headlines we just saw the other day, Clubhouse worth $4 billion valuation. If someone comes and buys Clubhouse for $3 billion, what does that mean? Does the founder still win there? Do the employees still win there? What is that? Is that considered a failure, right? Can you talk about that? And does that happen often where we read these headlines, but actually what happens in the outcome is because, to your point, we've maybe hyped up how much it's valued at, that someone actually doesn't come in and buy it for that much. And you're kind of stuck with it. Talk to me there.
Yeah, so I think everyone will win if the amount that it's currently valued or that they're selling for is more than what you put in. So let's just say, like, I know some companies that have already raised over, however many hundreds of million, then if they only sold for that hundreds of million, then we're all just at a wash and actually probably lost money due to time value of money. So like when Clubhouse is valued at 4 billion, I think everyone's going to win. I don't know how much they put in, but I'm sure it was not anywhere close to that. But there have been, and I can't think of any offhand, of any examples, but there's some where if you're selling for, let's just say you raised 100 million and you're only selling for maybe 100, 150, you might have broken even, and in fact might have lost money because of all the other things that are going on while you're working on the company. So yeah, a lot of the headlines can be misleading if you don't know how much was raised over the course of that success, because $1 billion outcome can be great if the company only raised 100,000. So for the investors, I mean, just at a simplified example, that's a 10, if they raise 100 million, $1 billion, 10 of a 10x situation. But most of the time they've raised actually a lot of money along the way to get to these big outcomes. So that's really how you can think about some of the wins, is not just how much they're selling for, but how much did they actually raise along the way? Because that first tells you how much the investors would get, because if they put in the amount that was raised and then they sell for that amount, you're getting the percent that you bought in at. So actually we'll maybe do a quick, I don't know if it's an example, but just talking it through maybe a bit more is just thinking about, like, let's just say you put in, I don't know, I'm trying to think of round numbers. So you invest in a company, you invest 100K into $1 million, a company that's valued at $1 million. So you have 10% ownership. So if that company sells for $1 billion, that investor owns 10% of that outcome. So that $1 billion. So now that's $100 million. So you invested 100K at the beginning for 10%. And now your 10% is worth 100 million. That's how VCs make money. So essentially you're looking for how much more did they sell for than what you bought in at. And the final point is that's the total value of the company, is that when I mentioned that billion, when they're valued at $1 billion and that's what they sell at, then you have to look at what I was explaining was the cap table, which is kind of you'll see a spreadsheet or a document where it shows everyone who owns any shares. So that's when everyone's now pulling up their cap table and seeing, oh, I own 10% of that $1 billion company. I now own $100 million. Like that's what I now, that's my value out of this outcome. But as we mentioned, things can have gone good, bad along the way. Maybe you had to sell some more of your equity to do X, Y, and Z. That's why you have to protect your ownership, because it's your percent ownership times the value that it sells at the end, which is your money. Like the company could sell for $1 billion, and the founders, if they only have 1-2%, that's what they're getting, which can be enough. But that's why I'm saying protect your ownership at the beginning, because you'd be surprised how many people are now working with so much less because they needed that initial capital and got some bad terms. So hopefully that was a super quick example, but yeah, I just want to make sure people get that it's the percent that you own at the end that is what you actually have. And it's usually not the whole thing. It's probably like 5-10%. Even as a founder, you're probably at maybe 20%. It depends on how you structured your rounds. So that $1 billion outcome is then split by all the people who are on your cap table.
Got it. Now, this is very helpful. Questions from the chat. We've got 26 people in here. You've heard us go back and forth about this. We're coming up on time. I apologize, Brittany, for the tech mishap in the middle, but let's get some questions going. I know Deborah had some questions here on the side about building relationships in the hostile financing and investment space. Can you maybe touch on that for us?
Yeah. So I would say it's something where you just try to spend time with an investor over time. And it can seem like, I don't know, like you're not getting anything from it, but you'd be surprised that investors, I can think of companies that I've met with once, and then they show me updates. Like I'm now on their investor or their community updates. So now I'm seeing how they're performing over time versus just versus one-time meeting. So you want to have as many touch points as you can with an investor to show that you can build and execute and kind of build on that track record, that you're explaining to them that you can do all these things. That's one way to build a relationship fairly passively. I find it very valuable, and I know a lot of other investors do as well. So just keeping us in the loop on what you're doing, and occasionally popping back in if there's something. But like I said, you kind of want to start those conversations early. So over the course of, 3-6 months, I'm now seeing a couple of data points. And then now you're raising and you're reaching back out saying oh, hey, Brittany, I know we spoke a few months ago. I'm now circling a few investors, looking at closing my round in the next maybe 6 weeks or so. Would love to jump on the phone again. That kind of thing is very helpful, because now I've had at least a couple other data points where I get, oh, wow, Deborah, we met once, we had a great conversation. In addition to that, she's updated me a couple other times, even if it wasn't a full-on conversation, but I understand where you're at. So I'd say meeting plus updates and follow-up is so huge. And don't be discouraged if you don't hear anything. I think VCs have a lot of conversations going. Yeah. But still do the work in just sending us the updates. I sometimes look at them and I'm not necessarily responding to everyone immediately, but I take it all in. And then the second thing would be social media has been incredibly useful for Backstage. So I will say that I've taken meetings with entrepreneurs that have DM'd me on Twitter. And then you can also see how we think. And especially Arlen, I think, does a really good job about just sharing thoughts and experiences, and I know other VCs do too. So you could just pick up a conversation and say, hey, I saw you said this, we're working on something that solves this, or whatever that is. You can just use those data points that the investor puts out there to kind of connect with them and see where the conversation goes. So I hope that helps.
Yeah, no, Deborah, was that helpful? I think it's, you think about relationships that aren't in finance. It's oh, don't just hit me up when you need something, right? You wouldn't, you don't want, that's not a good friend, right? Someone that only reaches out when they just need something, and, just continue to build a real relationship because you also don't know where the other opportunity might lie, right? I'm trying to get so much money from Backstage where I might give you an update and Brittany says, hey, I can find you a customer, right? I just found someone.
And that has happened, yeah.
that had that problem. You all should meet, right? That to me is probably more beneficial than getting, a $50,000 check, right? At a certain point, it's oh, I have a new customer now that I can go make real revenue on.
Yeah.
Which is amazing. Any more questions? I don't know if you be careful if you're submitting them in the event chat or just making sure everyone is good. We're almost at time though. So Brittany, I'll maybe pass it to you. Anything, that you would like to just say as a parting word of advice to these entrepreneurs as they go back to their Saturday and just think about, it's also a long game, right? Like we talk about this as if like, oh yeah, you're going to raise a round and then boom. And then, but like, what can you tell everyone around like, the length of time that this stuff takes and like being patient on the journey, if anything?
Oh yeah, I think patience is definitely something that entrepreneurs need to kind of develop if they don't have it already. And you're so right. Like I think of companies that I met companies before Backstage that I either saw at a pitch competition or knew personally, and I could not invest. Like, let's just say 2-3 years later, now at Backstage, I was able to invest in that company because we just stayed in touch. And they knew that in the back of my mind, I was working on also getting into venture and also being able to fund companies. And then those relationships, just wanted to underscore that the outcome might not be immediate. But I think just being connected with people who can understand your journey and really hopefully find value in what you're building, staying in touch with those people, yeah, it might take time, but there's real benefits that can come from that. And just for underrepresented founders in particular, I will say that sometimes the journey can be even a bit longer. But I think finding value in our own communities is something that's not explained or talked about nearly enough. So I think people keep talking about going to different VCs or different ways to get capital. And unfortunately, only like 2% of VCs are Black partners. I think I can't remember the stat now, but it's single digit percent. But I think there's people in your networks that might not be necessarily capital providers, but people that do that can bring value to what you're working on. So if it's people in different industries, people might have experience in different, just areas that will add value to what you're working on. So make sure that, I think building community with people on your journey cannot be overstated enough. I've just seen it work so many times. I watch Harold do it, and he's doing phenomenal at this, and just really building on that. And then before you know it, you do have value coming back at you if you've spent time building value in these communities. So I definitely think underrepresented founders can use that to our advantage, because we have value in our own networks. So want to make sure that people are tapping that as well. Obviously still reaching out to investors that they want to connect with, but just looking around and saying like, maybe I do have people in my network that are people that I can learn from and benefit from and might add value to what I'm working on.
Got it. One more question just slid in here. Two more. One, they ask, can they have your contact info? So so you can put it in the chat there. But Anthony asks, how do we tell if the business, they are not suited for VC? What are some just quick signs? I think we heard earlier today, tech businesses are generally good for VC. But like, what if I have an agency? What if I have a baking shop? What if I have a t-shirt company or product? Can you talk to us about why maybe those aren't good for VC and maybe try to go some other route?
Yeah. And I did realize we'll answer that, but wanted to point into the chat that I added just a resource for documents. I know we did spend a little bit of time at such a high level on some of these documents. But one, I think the NVCA, which is the National Venture Capital Association, does provide at least some templates or some base kind of format for a lot of the convertible note and SAFE, I believe. I think that link takes you there. I want to say that's what some of our founders, we had a discussion about, just like where these are living, these documents. So take a look at that if that's of interest. Just drop that in the chat. But yeah, back to your question on, actually, I think I did actually miss your question. I'm sorry.
Just like, how do we know if the business is suited for VC or not? What are some telltale signs really quickly? And the 2
Yeah,
minutes.
and I think it's up to the founder. Like nothing is wrong with a business that is not fit for VC. I think most businesses are not. Venture capital is really only for businesses that are suited for high growth and a big outcome. Like I'd say 100 million plus is what we're all targeting. Ideally, even more than that, but big outcome, fast growing. You're looking to bring on employees and scale a business. So I would say one thing that I notice is when founders are building something where they're saying that the max value that this could get to is only, 50 million, even if, and I ask this question to some in my pitch meetings, I do ask, like, if everything went in your favor, you had all the success in the world, you had all the resources, what does this business look like? Like, give me that picture. And if that doesn't excite me to a point where I can see a potential for this generating a big return for the fund, then it's just not a fit. Your idea of success is great, and it might just not be venture capital. So I'd say the number one factor within that is just that the outcome most likely would only be a sale of something kind of small, and small in venture capital terms could be huge for an individual.
Correct.
So just know that could be great for you, and nothing is wrong with that. And if you sell your company for $10 million and you bootstrap that company, you now have probably $10 million versus if you went the VC route. I know it's just that a $10 million outcome just isn't, it will not help us financially. Our whole job is to make money for our fund. And if we won't make money on a $10 million outcome. So that's kind of the disconnect there. So that's mainly the reason, is just that the business is not going to generate enough of a return that we can get involved, but it could be great for you. So I don't want to discourage anyone from going down that road. It's just not for us.
Yeah, 100%. Thank you so much, Brittany. We've had a pretty fruitful conversation. Everyone put some claps and snaps in the chat for Brittany. Thanks for taking the time. Thanks for also dropping your email. Everyone, please spell our name correctly, show your revenue, do your math, and make sure. But it was a pleasure talking to you, and great to be connected with you, Brittany. And I imagine we'll have more in the future. Apologies for the neighborhood here. But,
yeah, thanks everyone for joining. Definitely follow Backstage, especially on social media in Arlen. I'm working on my social media, so also maybe take a look over my way. But would love to just kind of, especially this audience, know and keep up to date with what Backstage is doing, since we focus on funding underrepresented founders.
Awesome. Thanks, Brittany. Thank you so much.
Yeah. Take care, everyone.